Canadian household debt surpasses 3 million for the first time ever. Let me just say, guys, money is not what you think it is, and it's not what it used to be. Let's just understand first and foremost that our dollars float. And what are the impacts on you and I when it comes to housing on our floating dollar? And why does this actually mean something for us? We are seeing in the market right now that people are borrowing more on mortgages and more on consumer debt than ever before. But we are also seeing a divergence in the two. And we need to understand that. First of all, what are the main impacts that we have to deal with? First and foremost, for every Canadian, everyone in the US, everyone cares about the cost of living. What does it cost for food? What does it cost for gas? What does it cost to clothe yourself, for shelter? And for the average Canadian, the cost of that is massive, but it's only massive against what you bring in. That, instead of cost of living, is now something called wage growth. So there's another point that we have to look at. So first of all, this cost of living impacts everyone. Now there's wage growth. Wage growth has been suppressed in North America for years, for actually, quite frankly, for decades. And as a result, you and I are making less money than the rate that the dollar is dropping in value. Now, what has been one of the major factors that we've seen for the difference between mortgage borrowing and consumer regular debt borrowing? And that has been interest rates. We can see in this chart very clearly that as mortgage interest rates dropped, there was more mortgage borrowing and less consumer debt. Now, don't be fooled, guys. What you're seeing is people using mortgage debt to pay out their consumer debt. So they're bringing more and more of their consumer debt into their homes. And then they're taking that and going back out and spending it. You see the jump right here on the chart as it jumps up astronomically. And you're like, how does that happen? Because cheap interest rates are giving people access to more money, more cash from the equity in their homes. They're paying off their debt. They're feeling good. They feel like they can afford more things, even though the cost of living is continuing to go up, even though their wages are not going up. It feels like you have more money to spend until the wheels fall off. And that's when interest rates start going up and we start seeing a decline in mortgage borrowing. We start seeing it literally goes off a cliff, guys. And we continue to see consumer debt going up. But now, why is that the case? Because people are needing to borrow more money to pay off all of that spending, all of the stuff they bought, the new cars, the Porsches, the Elantras, with all sorts of the new iPod Air headphones and all of those things. They are now having to pay the price for buying all of those things, putting them on their credit card, and they're watching their consumer debt going up. And because mortgage interest rates have gone up, everyone is paying thousands of dollars more than they were before just to have a place to live. And we've seen the reaction. People are in tents. People are going to food banks. These are the impacts of all of this extra borrowing. Now, the important part that we're seeing right now is that interest rates are starting to fall. And it's because you can see in the chart, buying is falling off. When people aren't spending money, the entire economy comes to a standstill. Canadians are racking up home equity line of credit debt at a much faster rate than usual. Once again. Okay, once again. Why is this once again? As we watch inflation do its part, the impact of cost of living, we can literally watch as people have to use their homes, their home equity line of credit, to try to balance out. People use it like a reserve fund. Most people use their home equity line of credit as like a reserve fund. Oh, I don't have the money. Let me go in. I can't pay my credit cards. Oh, I need to replace my car. And into the home equity line of credit you go. And the further you go down into that line of credit, you lose the ability to pay that back. And so then people jump back to consumer credit. So there is a up and down seesaw motion that happens in every household when it comes to using a home equity line of credit. The fact that we're noticing at a faster rate, that it's changing at a faster rate, only shows what we've seen in the interest rate market. We saw interest rates drop very quickly. We saw them rise very quickly. And now we're watching them starting to drop really quickly all over again. Guys, cost of living has gone up. Wage growth has stayed stagnant. We've watched as mortgage debt has continued to go up. We've watched as consumer debt has continued to go up. We've watched as people have used home equity lines of credit, their equity from their homes, to try and stay afloat. Amongst all of these things, we are walking into a low rate interest rate environment, and we're also seeing impacts from the US and tariffs, but we'll get into that into a future episode. But that's in this week's episode of the Four Horsemen of Real Estate. See you guys next time.
When the ones around trusting their word, they walk the talk in the world of investment, they make their mark.